and welcome to our TIE Innovator webinar, Enabling Institutional Access to On-Chain Yields. I'm Heidi Pickett, Chief Business Officer with the TIE, and I'm excited to be joined by Griffin from Reserve and David from XE. Just as a quick reminder, the information contained in this webinar is for informational purposes only and not intended as investment advice. Okay, let's dive in. I think it would be great just to start off with introducing yourselves and maybe a high-level overview of your organization and its mission within the digital asset ecosystem. Griffin, do you want to kick it off?
Yeah, sure, Heidi. Thanks for having me. Hey, everyone. My name is Griffin Peer. I'm Head of Business Development at Reserve Protocol. And Reserve is a DeFi protocol that is really a platform to allow institutions to launch indexes of crypto assets on chain. And so what that means is it's really like ETFs, but fully on chain, permissionless, and self-custodial. We call them DTFs, or decentralized token folios. And these indexes can be they can range from total market indexes similar to an S&P 500 style, or yield generating indexes. So, for example, we have an index of liquid staked Ethereum tokens, and you would get the diversified staking rate, and some other stablecoin indexes as well.
Great. And David, over to you. Tell us a little bit about yourself and XE and what you're doing in the yield space and providing.
Yeah, sure. Thanks, Heidi. So I'm David. I'm a founder at XE here, and XE was founded with a broad vision, which was to help all capital allocators optimize their portfolio. We think that beating inflation and monetary debasement is basically top of mind or table stakes for everybody out there. And so if you look at the opportunities to do that, crypto has been one of the best performing asset classes in the last 11 or 12 out of the last 15 years. And so our flagship product, Unity, allows allocators to gain exposure to crypto-derived yield without the volatility of just holding the underlying or the operational complexity of figuring out how to move on chain and take advantage of all of the various protocols that are out there. And so in short, we make crypto native yield accessible in a way that feels familiar to a traditional treasury product.
Nice. I think it would be great to start with sort of the big picture. Like, how would you describe the current state of institutional engagement in DeFi today? Do you think we're still in early days? Just kind of how far along are we in the process?
I'm happy to start on that. So I certainly feel like we're at an inflection point. Just by way of background, I was one of the early team members at Algorand, and I was there for a number of years helping build that layer one. And back in the day, it was Ethereum, Algorand, and this new thing that was on the horizon called Solana, right? So to put it in context, we've seen this industry mature a lot over that time period. And what's super exciting about this moment in time is if you look back January of last year, 18, 20 months ago, there was about $1.5 billion in these yield bearing assets, these yield generating stable positions. Today, we've crossed over 18 billion, and we see that trend only accelerating. Our internal forecast is that we'll be at over 75 billion deployed into this product category over the next 2 years. And so I think you're just seeing institutions, regulation, and capital really start to converge on chain, partly because of what I outlined earlier, which is this is one of the greatest places to really beat that hurdle of monetary debasement and inflation.
Yeah, I'd echo what David said. I think momentum is accelerating this year. I think it was early 2025, institutions were holding roughly 15% of Bitcoin's supply, and I think half of all hedge funds are allocating to digital assets or exploring it. So we're no longer really in this exploring phase. Institutions are beginning to allocate meaningfully. And I think that's especially true where there's clear frameworks for custody, compliance, risk-adjusted yield. And so we're now at the point where, there's the infrastructure maturity to kind of meet these institutions and meet the regulatory and compliance requirements that they have. And now I think it's a question of whether these DeFi native yields can truly scale at institutional sizes.
And are there any sort of barriers or risks that you see that would sort of prevent us from achieving that 75 billion or even going higher? Like, are there any gaps in the infrastructure or, regulatory that's going to, be a, detriment to, further growth in this space?
I think, in my opinion, it's still operational rails for seamless onboarding and offboarding of capital. We're closing the gap between DeFi native and TradFi rails, but there's still significant differences in terms of user experience and just, like, frankly, ease. And so I think institutions are starting to meaningfully allocate to digital assets, but the way they do so is there's a broad spectrum between some being on-chain native and then others through kind of TradFi wrappers. And with a lot of institutions, once you have a vehicle that's only accessible on chain, the conversation kind of halts and they're unable to move forward. And so I think that's an operational gap that needs to be closed.
Yeah, so I don't want to get bogged down in the regulation side because that tends to, be a long detour. Certainly, having the capital markets or an infrastructure bill that's akin to what we've seen with Genius would certainly help. But to Griffin's underlying point, there's this bifurcation that's happening within asset allocators. There are those that are moving on chain, replicating their traditional workflows with the tools that exist today, partnering with people like Copper, Anchorage, the TIE, Reserve to basically map one-to-one what they already have in their legacy infrastructure. And then there are those who are waiting for crypto assets to get, or crypto yield to get wrapped in these traditional, type of instruments like the digital asset treasuries, putting these things in ETPs, and both are happening simultaneously. I think it just depends on, what your comfort level is and what your operational, kind of belief is around how you want to manage this at scale.
Yeah, that makes sense. And just kind of continuing on this theme a little bit, Griffin, how are institutional allocators evaluating Reserve's diversified index strategies versus more traditional centralized stablecoin issuers, maybe in terms of risk, return, and compliance and whatever else?
Yeah, I think, with any new product, really, our indexes included, there's a threshold for an additional yield premium that's kind of required against traditional issuers that have deep liquidity, trust, and social proof. And so, that premium might start out higher at first, but when the product is unproven and maybe the protocol is new to an institution. But what we've seen is that premium starts to converge towards zero as the asset in question grows in size, as the institution becomes more comfortable and there's more trust and Lindy for the product. And so we've seen kind of institutional demand increase as they see their peers allocating and more TVL and liquidity in these products. It starts to just grow and kind of snowball into itself.
And David, continuing on this sort of risk management and operational design, what were the choices underpinning Unity's ability to scale for institutional allocations?
Yeah. So I opened at the top with XE's mandate was to really help capital allocators optimize their portfolio. And so there was a bunch of different types of products or strategies that we could have employed to achieve that goal. But we felt, certainly as we deploy our own capital into digital assets, and as we thought about what would be the appropriate stepping stone for larger allocators, it really comes down to these kind of core three tenets. One is this concept of access to crypto-derived yield without taking direct exposure risk. People can already bet on if Bitcoin's going to go up or down, if ETH's going to go up or down. They have, ability to do that. But what a lot of allocators don't have is the ability to gain exposure to that type of that yield opportunity without the directional impact. And so that was core to the design choices around Unity, is create something that is a quote unquote principal protected or delta neutral in design, but all of the yield is derived from crypto markets broadly. And then to the topic we were just talking about, having custodial security, having infrastructure, being able to pass the due diligence questionnaires that traditional allocators are accustomed to. And so partnering with, like I mentioned before, custodians like Copper that allow for off-exchange settlement, so you aren't taking overt counterparty risk. You want to minimize things like the Bybit hack or the FTX collapse, et cetera. And so having robust operational infrastructure in place was also paramount. And then the last piece, which I actually think crypto and blockchains are able to provide at a level that quite simply traditional assets can't provide at this scale, is transparency. And so we have 24/7, 365 visibility into all of our holdings, everything that's backing the UTY token that is issued on chain. You can verify how much is in circulation. And so it's really moving from a just trust me mentality that crypto was kind of born out of into a more robust verify, everything's on chain, audible, transparent. Any institution that wants to deploy can check for themselves in real time. And so I think it's actually a big shift in the ability to get comfortable using these rails.
Yeah. And Griffin, back to you for a second. How do you see efforts like DSI or the Digital Securities Initiative shaping institutional access to on-chain yield?
Yeah, I'll just quickly, for context, give a background on what DSI is. So it's the Digital Securities Initiative is a program within the Reserve ecosystem that is working to create a framework that can integrate tokenized securities in DeFi for public and retail use in a regulated way. So they've been meeting with the SEC Crypto Task Force and trying to develop basically a way for assets to be interacted with in DeFi, with Uniswap, Aave, and other kind of DeFi primitives in a way that meets traditional regulatory standards for KYC, AML, and other frameworks. And so I think this is really important for lowering that barrier for institutions to interact with DeFi and on-chain yields, so they can do so in a regulatory compliant way, and not have to keep their risk management team and their legal team up at night when they're entering into this space. And so I think once, and there's a lot of people working on this problem, and so it's going to solve a big problem in that it'll allow this huge inflow of institutional capital that might not have the operational capability to allocate right now or the regulatory capability. And so at Reserve Protocol, we think this is like an amazing unlock because of the ability for new tokenized products to be created and interacted with. And we look at tokenized products as kind of money Legos that can then be put into the indexes that are built on Reserve. And so we think of it as like the more the merrier. The cooler and more unique and innovative tokenized products exist on chain, the more creative indexes that we can create on the protocol.
Very interesting. And David, how does XE's design ensure institutional scale deposits and withdrawals can be managed seamlessly? Particularly, thinking about without introducing portfolio imbalance or counterparty risk.
Yeah, so liquidity management and the ability to service redemptions is as important, if not more important, than just the raw yield that can be generated. From XE's perspective, we use programmatic queuing where large mints or large redeems are processed in tranches. We break those up and run them against live market parameters, so we minimize the impact or the slippage or the transactional cost. And so in that way, we ensure the portfolio stays balanced, and we're also able to preserve as much return effectively as we can for depositors. On top of that, so beyond just our operational capabilities and execution capabilities, we also maintain liquidity buffers at all of the major venues. And so we're able to handle normal flows without having to do significant amounts of transaction executions or unwinding of positions. We also diversify our positions across multiple venues, so we aren't concentrated on just one venue to minimize that counterparty risk. And so really what all this means in practice is that a pension fund, a corporate treasury, 8-9-figure allocators can move a significant portion of their position without destabilizing or impacting the flows for the underlying product. And so that's one of the, another advantage of the way we've designed Unity is that it's scalable into the billions of capital deployed, and setting it up this way allows it to do so.
Got it. We very lightly touched upon sort of the institutional on-ramps, and maybe there's more work to be done on this front. But what are you seeing? Which types are you seeing as proving most effective in driving yield participation at scale, and kind of where does it go from here? And I open this up to either of you or both of you.
I'm happy to start. So I'm going to bifurcate my answer between on-chain institutions and more, I guess, less crypto-native institutions. So for the first segment of our users, for crypto-native institutions that interact on-chain, I think the biggest draw and on-ramp, I'd say, is composability in DeFi of the products. We have set up lending markets, liquidity pools, and other ways for institutions to earn yield on the products that are also, have native yield as well. And so what we've seen is this drives huge demand in like a leveraged looping trade for the products to have increased exposure and increased yield generation. And so that's been a big unlock on the on-chain side. And then for more traditional institutions that aren't as crypto native, we've actually, I'd say the on-ramp is not an on-ramp into crypto, it's an on-ramp out of crypto, meaning like creating a wrapper of the product that exists on TradFi rails. And David mentioned this earlier, this looks like ETPs, ETFs, qualified custodian integration. All of these are efforts to lower the barrier into entry for these more traditional institutions that don't have this DeFi kind of workflow either figured out or just have constraints in that. And so I think what we'll continue to see is crypto meet TradFi where they are right now as the easiest way for that capital to be allocated. And then hopefully over time, as they grow their knowledge and risk tolerance and operational capabilities, then there'll be kind of a convergence of the two, and that there won't be that barrier.
Yeah, similarly, I'd say the biggest unlock for us is meeting allocators where they are. And so being able to mint our products directly from qualified custodians like Archax, FCA regulated digital asset exchange out of London, or Anchorage. Sergio Mello just joined, the Anchorage's head of stablecoins just joined Xe's advisory board. And so bringing these products into places that these allocators already have workflows set up, that's been a major, as Griffin put it, on-chain unlock. And then as he just talked about, putting wrappers around these to meet people that don't necessarily want to use crypto custodians or crypto rails. And so Xe partners with digital asset treasuries, foundations, other corporate treasuries where they have a pile of assets in order to fund operating expenses, which are denominated in fiat. They're looking for some way of generating positive cash flow. And so we partner with them to integrate our products into their portfolio, generate cash, offset those expenses. And so, yeah, it's just really meeting the individual client where they're at.
Yeah, that makes a lot of sense. And, again, we've kind of touched upon this a little bit as well already, but maybe you can go a little bit deeper. Just as institutions demand stronger controls around sort of custody, access, and compliance, how are you designing your infrastructure to minimize trust assumptions while still meeting regulatory and operational requirements?
Yeah. Sorry, David, go ahead.
Go, Griffin. You go.
All right. So yeah, I think, as you mentioned, Heidi, like trust and security is the name of the game with these institutions. It's absolutely required, and honestly, just table stakes in terms of having any sort of allocation. And so, at Reserve, that's our highest priority. We have over 10 smart contract audits, and are allocating millions of dollars a year into continued audits to make sure that we have the utmost reliability and confidence in the smart contracts. There's also a $10 million bug bounty, which I think is the second or third largest in all of crypto, and has been live for, I think, 4 or 5 years without a single dollar being paid out. And then on top of that, there's one-to-one asset backing, which is 100% verifiable on chain. And all of these are designed with institutions in mind to make sure that our infrastructure meets their requirements. And this is kind of just what we do at the start of every conversation with institutions. And this is part of building that foundation of trust with them. And then once we have that foundation, they've conducted diligence, become a little bit more familiar with the protocol and how it works, then we can talk with institutions specifically to understand what additional or maybe bespoke criteria they may need. And usually, if we don't meet it already, able to create some sort of tangential feature to enable it, whether that's a bespoke front end, having a TradFi wrapper, or having some sort of reporting mechanism that they need. So yeah, I think having the safety and diligence is like the absolute priority to get these institutions to allocate and to get them to trust the protocol. And then after that, it builds on itself, and you have more social proof, and peer institutions will begin to trust and allocate as well.
Yeah, I think, echoing everything that Griffin said across the stack of on-chain security, audits, real-time verifiable deposits, and all of the technology that goes in supporting those initiatives, right? That absolutely table stakes. The broader kind of backdrop is that built on top of trustless infrastructure that is blockchains, this is just fundamentally a better environment to achieve trust constraints or trustlessness by design, depending on your turn of phrase. And so with that infrastructure, you're able to do things that quite simply just wouldn't be possible if you didn't have all of your ecosystem participants on a unified rail. And so we just announced our verifiable proof of reserves. I won't get into the technical details of our trusted execution environments and the zero knowledge proofs, but the net result is that you can have 24/7, 365 visibility into where all the holdings sit. You don't have to ask, you don't have to get a third party to sign off on a custodial report on a monthly basis and lose visibility in between. We really moved to setting the gold standard of security, verifiability, and trust. And so that's the philosophy, and that's why I certainly, as a practitioner, have been so excited about blockchain tech for the last decade. Is that it is the rails that enable us to build this infrastructure on top of.
Amazing. It's come a long way since TradFi days, for sure. And just if you could solve sort of like the top barrier that still exists around the user experience, whether it's onboarding or transaction workflows for institutional teams to access or participate in on-chain yield, what would that be, particularly for those that are used to TradFi systems? And further, how are you solving it? And how are you approaching it and going to solve it?
Griffin, I'll start with this one just to change it up.
Yeah.
Well, I think, if you'd asked me this question a few years ago, I would have said that the infrastructure still needed to get built out. The user interface, wasn't quite right. By abstracting a lot of those, kind of pain points, we've been able to invite a significantly a larger amount of capital on chain than we would have otherwise. Is signing transactions with a hot MetaMask wallet still the default for some people in the space? Yes. Is that the best path forward? I wouldn't advise it. But I think the biggest barrier is really cultural, because there are a number of firms that know that the best way to access this yield is to be on chain. And so then it's, how do I change the culture of my organization? How do I retool my organization? How do I integrate, all of my pre-existing workflows with this new technology? And that just takes time. It takes, stakeholder buy-in, et cetera. And so I think we've actually shifted to a point where the infrastructure, by great work and effort at companies like Reserve and XE and others, we can now build and meet all of the reporting requirements or exceed them in a lot of these due diligence questionnaires. And so it's really cultural about, if they want to be on chain, how do we help them accelerate that process, get them there? Whereas if they don't want to be on chain, well, great, here it is in a DAT or an ETP or another product that you can already access.
Yeah, I'll echo David's points on really lowering what is required for them to be on chain if they don't have that existing culture, and basically meeting users where they are. And so I think that is either through DATs, through ETFs, through ETPs, or even centralized exchanges and other fintechs that are abstracting away the crypto experience. I think to unlock that real, full adoption that we've kind of been talking about in the industry for years now, is going to be the step that's required, rather than going through the compliance organization of every single company to overcome that barrier. And so, yeah, I think in the short term, we probably have to meet TradFi where they are, with the long-term goal of then blending that and having just finance rather than TradFi and DeFi.
Yeah, makes sense. The cultural piece can be often challenging to overcome, but I feel like there's a lot of work that's been done on that front as well. So great to see that sort of maybe the more technical barriers are not there anymore. But kind of moving on, what are the trends that you are seeing in terms of where the traction is taking place in terms of on-chain yield strategies, and to the extent that you can talk about how these influence your roadmap going forward? Would love to hear a little bit more on that front from each of you.
Yeah, sure. Happy to start. So for on-chain yield strategies, I think there's kind of 3 different buckets that we can talk about for reserve products. First being stablecoins, of course, hot topic. To be honest, for stablecoins, so for reserve protocol stablecoin yield strategies, they're fully on chain and fully in DeFi, and it's hard to compete with in a scalable way for on-chain yields to compete with products that use off-chain strategies like Athena. And so I think these products have traction and work on a smaller scale, but to get to the real trillions number or even billions that these TradFi institutions need, we need to figure out a way for DeFi yields to scale to meet that demand. Now, for staking products, we've had a lot of success with liquid staking tokens, and institutions are interested in the liquidity of it and not having delays in withdrawals. And then also, as I've mentioned previously, the composability in DeFi, to be able to, once they have it, a yield generating product, they can do something with it and borrow against it, lever up, even short it. And so we've seen high demand for a leveraged looping trade. Our ETH Plus is our diversified staking index. And that's, I think, one of the largest collateral vaults on Morpho now, I think the third largest. And so there's high demand for yield on ETH and other staking products. And then finally, for blue chip index exposure, so think of top 10s, top 25s, institutions are showing demand for more advanced trading strategies. So what that looks like is more of a basis trade to capture the funding rate or hedging their portfolio by shorting the index. And I think largely that's been done with perps so far. But as we are starting to build spot products, spot versions of these indexes on Reserve Protocol, it introduces a cheaper and a more efficient way for them to execute these products, as well as opens up these strategies to it opens it up to beyond the most advanced institutions and allows ones that are more kind of new to crypto and new to trading to participate.
From our seat, so certainly there is demand for the staking products that Griffin just outlined. People want to express long in a particular asset, and then if you can earn, the staking rate to offset basically network inflation, you're leaving money out. You're losing money if you aren't, right? It's crypto's version of debasement, if you will. And so going long and staking is by far, the kind of crown jewel in crypto today. However, as I mentioned previously, we think that the people who allocate in that way either have a pretty sophisticated view on the market, or they have a position that they're trying to represent. Whereas for the vast majority of capital allocators, they just want double-digit yield on a cash-like instrument, right? I don't necessarily want to take a bet on ETH versus SOL versus XRP versus insert your favorite token here, right? And so in that instance, as Griffin mentioned, we simplify the process of gaining access to that, to the basis trade strategies of going long with a staked asset and then offsetting that exposure with a perpetual short. And that's how we're able to basically access, double-digit returns that are derived from these crypto assets. And you don't have to onboard with 15 different exchanges. You don't have to understand how perpetuals work. You don't have to manage your unswept P&L. You don't have to onboard with off-exchange settlement providers. You don't have to have a trading team. You can access all of that in a simple token allocation or via your favorite DAT or ETP. And so through that, we were really trying to simplify the ability to gain access to these markets.
Amazing. And then kind of thinking ahead a little bit, what major developments do you anticipate for these types of products over the next 6 to 12 months? I know you kind of sort of touched upon it, like thinking about your roadmap, but is there anything that doesn't exist today that there's a demand for but hasn't been figured out from a solution standpoint, or kind of where do you see this evolving?
I think for me, it's just about continued ease of access for non-crypto natives to allocate. The SEC just approved the generic listing guidance for ETFs. And so I think there's going to be a flurry of applications for new crypto assets, and then also more creative multi-asset products. And then there's also going to be continued advancement of what we like to call the DeFi mullet, which is DeFi in the back and fintech or TradFi in the front. So Coinbase just announced 10% USDC yield through Morpho lending vaults, and I think that theme is basically the equivalent of these TradFi wrappers that we've been talking about throughout this webinar. And really what the theme of this all is abstracting away the crypto experience, meeting users where they are, and making it as seamless as possible to access these yields. And so I think we're just going to have continued innovation on what types of products are on the back end, and what types of exposure and yields can be offered. And then what are the vehicles that these are offered through. DATs are all the rage now, and they continue to offer more and more interesting underlying assets and trades that they're developing. And so I think that will push the envelope and continue to drive innovation.
Yeah, I agree. From Exy's perspective, our original thesis here is that this offering this basis trade or access to this operationally complex mechanic within crypto has been spot on. A lot of people have started integrating this as part of their cash management, as part of their strategies to offset their ongoing OpEx. And so now that it's baked in, we're seeing people start to compose on top of it. And so whether that's on-chain in DeFi or just do additional things with the positions, some examples would be, posting your assets as collateral, borrowing stables or dollars against that, and then deploying it into this strategy. Or conversely, using our receipt as collateral, borrowing against it, and then potentially expressing a different position, like going long. And so as we are working with the allocators, we understand that there's more opportunity to, again, reduce that operational burden. And so if you want, all of your payments to not be in dollars, but to be paid in, insert your favorite token here, we're going to continue to work on streamlining, optimizing so that the treasury teams don't have to go on chain and then start TWAPing. That could be baked in programmatically. So we're pretty fired up about now that it's live on a number of partners, kind of balance sheet, helping them grow and expand the utility within that balance sheet.
Amazing. Final words for each of you. What is the number one thing you would like everyone listening in and watching this in the future to take away from each of your respective organizations? And where can they find more about what you're doing, and how can they connect with you?
I'm happy to start. So actually, this morning, Reserve had a very exciting announcement about a diversified blue chip broad market index that tracks the CF Benchmark's large cap crypto index that is available for trading on Kraken. And so this is kind of the first time we've seen a rebalanced multi-asset index that's available to users fully on chain. And what we're hoping is this rolls into a flurry of, as I mentioned, like these other index products, these other kind of full portfolios in a single one-click asset to allow for generation of yield, to allow for broad market exposure in this simplified and abstracted way for users and institutions. So I think our ultimate goal is to create almost the S&P 500 of crypto, where users and institutions are able to, just set it and forget it, and not have to track several DeFi protocols, on-chain rates, portfolios, and they can just kind of hold their exposure in a single index. And so I think what we're looking forward to beyond this is continued distribution and continued integrations to have these products have utility in more advanced strategies and in more advanced trades, so that the institutions can continue to find value and abstract more yield from them.
Amazing. And if somebody wants to be in touch with you to
sorry. So reserve.org is where you can go to find more information. All of our indexes are permissionlessly mintable and redeemable on app.reserve.org. And then now you can also go to Kraken to find the large cap index.
Perfect. Congrats on that.
Thank you.
Amazing. David, over to you.
Yeah, so from our perspective, if you want the best risk-adjusted yield in crypto, we think that XE is the best place to access that. We think these delta neutral strategies are becoming the treasury bills of DeFi, and it just so happens that they pay double-digit returns as opposed to 4%, 4.5%. And so if you are interested and you don't want to take a long short position on the majors, please you should investigate XE. Reach out. You can reach us at xe.fi or xe.fi, and then you can drop me a line personally at david@xe.fi. So we think that, again, we're growing from 18 to 75 or 100 billion, and that's just the tip of the iceberg. And there's a lot more capital to be deployed in these markets.
Amazing. We have come a long way in a short time, and I'm excited to see what the future brings. And I think it's only going to be a more lively discussion with much bigger numbers that we'll be talking about if we are to reconvene 6 months from now. So thank you both, David, Griffin, for joining our TIE Innovator webinar today around on-chain yield for institutions. And thank you everyone for listening in. And I hope you will join us at a future TIE Innovator webinar series. Thank you.
Thank you for having me.